walk into a bank, not just any bank, one of the most powerful banks in Ireland. The marble floors shine, the suits are crisp, everything feels controlled, safe, predictable. Like this is a place where money grows, where investments are managed, where the system works exactly as it should. But behind one office door, something strange was happening. Every year, just before the books were closed, millions disappeared. Not stolen, not lost, just moved, quietly, from one place to another. And then, just as quietly, brought back, like it was never gone. No alarms, no headlines, no one noticed. Until one day, someone did. And what they uncovered didn't just expose one man, it shook an entire country. In December 2008, in Dublin, the quiet system of trust cracked open. The chairman of one of Ireland's biggest banks, Anglo Irish Bank, admitted something that sounded almost impossible. He had hidden 87 million euros in personal loans, not outside the system, not in offshore accounts or complicated shell companies, right inside the bank, right in the heart of the Irish financial system. These weren't normal loans. These were loans that disappeared right when they were supposed to be reported and returned later. A perfect trick to fool auditors, shareholders, and the public for years. The man at the center of it all, Seán FitzPatrick, a banker who had spent nearly 2 decades building Anglo Irish Bank into a powerhouse. Under his leadership, the bank exploded in growth. Its stock price soared. Its profits crossed 500 million euros a year. At its peak, the bank was worth nearly 13 billion euros. FitzPatrick himself held nearly 80 million euros in shares. It looked unstoppable. But beneath that success, there was a system built on illusion. Because once the truth came out, everything began to unravel, fast. Within 24 hours of FitzPatrick's admission, the fallout began. He resigned. Then the bank's chief executive, David Drum, stepped down. Then another director and another. Watching it all unfold was like watching dominoes fall, one after another. But the real question wasn't just what happened. It was, how did this go unnoticed for so long? The answer reveals something much bigger than one man. Technically, the bank was reporting its loans. Every year, Anglo Irish Bank disclosed how much money it had lent to its directors. But there was a loophole. The figures were recorded at a single point in time, just one snapshot. If you could make the loan disappear just for that moment, it wouldn't show up. And that's exactly what happened. FitzPatrick temporarily transferred his loans to another bank, the Irish Nationwide Building Society, right before the reporting date. Once the numbers were reported, the loans came back. On paper, everything looked compliant. In reality, it completely defeated transparency. And this wasn't a one-time trick. It had been happening for nearly a decade. 8 years of numbers, audited and published, all hiding the truth. Zoom out for a moment, because this wasn't just about hidden loans anymore. It was about trust. Trust in the banking system, trust in regulators, trust in the country's financial stability. And that trust was already fragile, because 2008 was not a normal year. This was the global financial crisis. Markets were crashing, banks were collapsing, governments were scrambling to keep economies alive. And now, Ireland's third largest bank had just admitted it wasn't telling the full truth. Within days, the government stepped in. At first, the plan was simple: recapitalize the bank, inject capital, stabilize it, move on. But something changed. Behind the scenes, things were worse than expected, much worse. So on January 21, 2009, in a sudden and dramatic move, the Irish government did something extraordinary. They nationalized Anglo Irish Bank, a private bank now owned by the state. Because letting it fail wasn't an option. The potential fallout could have triggered panic, withdrawals, and a chain reaction across the entire banking system. The consequences were massive, not just for shareholders, but for taxpayers. Billions of euros were injected into a bank built on years of deception, and even that wasn't enough to stop the ripple effects. Stock prices of other major banks plunged. Confidence in Ireland's financial system collapsed. Public anger surged. And the scandal didn't stop with FitzPatrick or Drum. Regulators came under fire. The financial regulator, Patrick Neary, resigned amid criticism that he had failed to detect these practices for years. Auditors, Ernst & Young, were lambasted for not noticing loans that were hidden in plain sight for 8 years. Directors and executives across related institutions, Irish Life and Permanent and Irish Nationwide, also resigned. And then there was the so-called Golden Circle, a mysterious group of 10 wealthy investors who had received massive loans to buy shares in Anglo Irish Bank in 2008, apparently to prop the bank up. The identities of these individuals were shrouded in secrecy, sparking public outrage. Some politicians argued the government was protecting them. Others demanded transparency. Eventually, the names were revealed. Belfast-born developer Paddy McKillen, Seamus Ross of Meneley Homes, auctioneer Brian O'Farrell, John McCabe of McCabe Builders, developer Jerry Maguire, Belfast's Patrick Carney, Jerry Gannon of Gannon Homes, Kildare businessman Jerry Conlon, Sean Riley of Magaro Riley, and developer Joe O'Reilly. These were the men at the center of the Golden Circle, whose loans and transactions helped conceal the bank's true financial state. But this wasn't just a story of wealthy elites. It was a story of systemic failure. A bank that should have been monitored, audited, and regulated had found loopholes to hide its risks. Loans that were supposed to be transparent were manipulated, and those in charge of oversight failed to notice. Every Anglo annual report contained a note displaying the total loans to directors. But FitzPatrick's actions meant the reports were misleading, creating a false sense of security for shareholders, regulators, and the public. By the end of 2008, when FitzPatrick finally revealed the 87 million euros figure, it was almost double the total of all other directors' loans combined. This was not a small miscalculation. It was an enormous breach of trust. And then the dominoes kept falling. On 7th January 2009, Finance Director and Chief Risk Officer Willie McAteer resigned. The government moved from recapitalization plans to outright nationalization. Shares were suspended on both the Dublin and London stock exchanges. The board, which had served under FitzPatrick, resigned. Confidence in Irish financial institutions was shattered. Even institutions tangentially linked were affected. The Irish Stock Exchange saw its index fall to a 14-year low. The Dublin Airport Authority's chairman stepped down because of his past association with Anglo Irish. The ripple effect was enormous. Investigations followed. The Chartered Accountants Regulatory Board examined directors' loans and the role of auditors. The financial regulator ordered an urgent review. The government debated emergency legislation to nationalize the bank.